Welcome to Unit 3 Accounting, Recording and Reporting for a Trading Business. As you know, we're using Neville Box's text. It is VCE Accounting Units 3 and 4. What I'm going to do is just go through the slideshow. You can pause it at any stage or go back to it. I hope it works. Okay, so the key knowledge that we're looking at is the applicable accounting principles and qualitative characteristics of accounting information. The elements of financial reports, so the assets, liabilities, owner's equity, revenue and expenses, and the twofold effect of transactions on the accounting equation. So what do we record transactions and produce reports? So we need to know how much our business owns and how much it owes, which we get that information on the balance sheet. Obviously, what we own or control is in our assets, and what we owe is our liabilities, the residual of which is our owner's equity. So anything that happens at all in your business will be reflected in the balance sheet. We need to know how much money our business is making. So this is when we produce our income statement, which is of course revenues and expenses. And we need to know how much money we have to meet our short-term as well as our long-term financial requirements, which is presented in the cash flow statement. Not everything will be on our income statement because we don't include our assets and we don't include our liabilities. However, our cash flow statement is for all cash transactions, including credit cards. It includes our overdraft. And so those two can be a little bit more complex, and you'll probably find they are the reports that you'll sort of have concerns with at different times, just to make sure. But the balance sheet is always exactly the same. Who do we create these reports for? That's a good question, because there are many, many users of financial information. Obviously, the owner or manager has to know the position that their business is in, the financial position, and it just helps for decision making, because ultimately that's what accounting is all about. Prospective owners, if you're going to sell your business, they need to know what they're purchasing and what it's genuinely valued at. Banks and lenders, financial institutions, obviously, because if you want to loan any money, they need to know they're going to get their money back, basically, and that they're going to enhance your business. Suppliers of goods or materials, as we've discussed, creditors and debtors. Relationship is really key to any business success, and so a good relationship will usually start with a good financial relationship. Creditors want to know that they are going to get paid. Government departments, so taxation, plus work cover, I guess superannuation, all the rest of it. Employees and unions, they need to know that you're actually not dodgy and that you're reporting everything accurately. And your customers, because particularly for big businesses, they invest in your business when they have a relationship with you, and they want to know that they're protected and that you're worthy of their custom. Okay, so the applicable accounting principles and qualitative characteristics of accounting information. We have 7 principles. We have the going concern principle, historical cost, entity, monetary unit, conservatism, consistency, and the reporting period principles. We have reorganised those, and I'll give you an image. We call it Sher sang at the MCG. So CHER-MCG. So that would be conservatism, historical cost, entity, reporting period, and then monetary unit, consistency, and going concern principle. You can organise it however you like, but that's how I remember it. Qualitative characteristics, relevance, reliability, comparability, and understandability. I always remember they're the 4 qualitative, once again, memorising things can just be a bit of a game in your head. You need to know the definitions of these, and they have been supplied to you by VCAA, and I have put them in your Kickstart package. So what are the elements? Elements are something that make up a whole, so they're the individual parts. We have assets, liabilities, and owner's equity, revenue and expenses. So they're the elements of financial reports. Obviously, in our income statement, the outcome is a net profit or loss. The cash flow statement, the outcome we are looking for is our cash at end. And so we follow that cash at the beginning plus cash inflows less cash outflows is cash at the bank at the end. The balance sheet as at. Okay, so the balance sheet always contains exactly the same information. It's always your assets, your liabilities, and your equities, your owner's equity. We will work with a T-form presentation. There is a narrative form though. So that is where it is sort of like a summary sheet. As we go on through Unit 3, we learn T-ledgers and we learn about debits and credits. If you keep your balance sheet in a T-form presentation, it actually will help you just so you understand the effects on the equation. Assets equals owner's equity plus liabilities plus owner's equity. All right, so page 18 to 19 of the text, if you can please review that. So it's as at, because we look at a balance sheet, everything that has happened up to a certain point in time, that will change from one day to the other. We look at our other reporting, like our other statements, our other financial statements for a set period. So for instance, revenues and expenses earned for the month of July, which will be the 1st to the 31st of July. Then we start from zero again and we look at August individually. The balance sheet, however, is an ongoing and ever-changing financial statement. Current assets. So these, you need to really be able to explain using the definitions. So if you're asked, for instance, why something satisfies the definition of an asset, you really need to work it in to this definition. So current assets are economic resources controlled by the entity intended to be turned into cash within 12 months. They include cash on hand, cash at bank, short-term investments, stock or inventory, stocks of supplies, so for stationery and all the rest of it. Some companies actually buy their stationery in stock, in bulk because it's more efficient to use that. But you've really got to count that and just decrease it as it's used. And debtors are accounts receivable, because we're going to get that back in cash within a 12-month period. Non-current assets, on the other hand, are economic resources controlled by the entity with the intention of controlling them for longer than 12 months for the purpose of generating income for the business. They include things like computers, vehicles, machinery, furniture, equipment, property, and long-term investments. So we might actually even loan money to another entity for a period of longer than 12 months. So they're our non-current assets. Current liabilities are current obligations of economic sacrifices due for payment within 12 months. They include bank overdrafts, short-term loans, and creditors or accounts payable. So a liability, obviously, it is a future economic sacrifice. Non-current liabilities are current obligations of future economic sacrifice, so deferred liabilities, payable over a period longer than 12 months. They include things like mortgages and other long-term loans. So the same loan, though, can be classified as current and non-current. The economic obligation, or what is owed in the coming 12 months, is classified as a current liability, and the economic obligation which remains outstanding beyond 12 months is classified as a non-current liability. So I'll give you an example of this. My home loan mortgage, for instance, say I owe $200,000 and my payments are $2,000 per month. So I owe $24,000 of that each year. I have my $200,000 initially. That would go into my long-term or my non-current liabilities. Each year, I owe how much? Yeah, $24,000 though. So the first year, my current liabilities would be $24,000 and my non-current liabilities would be $176,000. The following year, my current liabilities would still reflect $24,000. That's what I owe that year. But my non-current liabilities would be reduced by a further $24,000. So I would owe $152,000. So you see, that's how it's the same loan, but it is separated in the balance sheet. Okay, so we have types of loans. We have an interest-only loan. So what happens is you take out the full amount and the principal, so that's the amount. So with my first example of the mortgage, I owe $200,000. That's actually the principal amount. That's the money that I've borrowed and I have used for my home. So in an interest-only loan, you only pay the interest that is owed on that. So just say I have a mortgage, $200,000 at 10% per year per annum. That's what I owe in interest. So the interest is actually an expense. And what did I say? So that'd be $20,000 a year that I owe in interest. I still owe $200,000 though. So I pay my interest and that's an expense because that's what it cost to borrow the money. And I just pay that $20,000 off. And at the end of the term, say it's whatever, 10 years, then I pay out the $200,000 as a lump sum. Installment loans are where you pay some of the principal plus interest off. So the scheduled payments are made over the life of the loan. Installments are usually monthly, fortnightly, or weekly. The total principal is assumed to be paid in equal installments over the life of the loan. Therefore, each year we reduce the non-current liability by reclassifying the current obligation, so what we must pay in the next 12 months, as a current liability. So we're paying the interest, so we might pay the $20,000 in interest broken up into, weekly portions. And with that, we might also pay $200 off our principal each week. So we're reducing what we actually owe. Please ask me if that's unclear. So revenue and expenses are reported in the income statement. Accrual accounting, which is matching revenues and expenses for the period to determine net profit or net loss. So that's the form of accounting we're using. And then our net profit or loss is then recorded in the owner's equity of the balance sheet. So while we don't put expenses and revenues directly onto our balance sheet, the outcome of our earnings affects our owner's equity. It's recorded under our capital as either a net profit or a net loss. So once again, just to reiterate, everything that happens affects the balance sheet. So what's revenue? It's increases in economic benefits in the form of inflows of assets or reductions in liabilities that result in an increase in equity other than contributions by the owners. So no capital contributions. They usually arise through the provision of goods and or services. So why we're in business to make money, and they include both cash and credit sales. Expenses, however, are decreases in economic benefits in the form of reductions in assets or increases in liabilities that result in a decrease in equity other than distributions of equity. So we're not including drawings in this. That's not an expense. It includes all expenses relating to the period, including non-cash items such as depreciation. For example, so wages, advertising, insurance, depreciation of non-current assets, and the cost price of stock sold, because we're matching. Remember, it's the matching principle. All right, so every financial transaction will have a twofold effect on the balance sheet. Welcome to the wonderful world of double entry accounting. I would like you to complete the following tasks on page 24, figure 2.7. The twofold effect of transactions on the balance sheet. This is really, really important. It's double entry accounting that we're doing, counting, and it's really good. So as a group, page 29 to 30, can you please complete 2.1, 2.2, and 2.7? Then questions from the text. Page 29, the summary questions, 1, 4, 6, 9, 10, 12 and 14, and then select 2 of the practical exercises to complete. And complete the internet activity on page 36. Thank you very much.